one thing is pretty close to being guaranteed, and that is the value of currencies decline over time. And we figure that every 15 years or so, the value of the US dollar gets cut in half, meaning your purchasing power gets cut in half. Not good if you have money in cash, not good if you have money earning a little bit of interest. If we talk about 15, 20 years out, your money will be less than half by that time. So how do you overset that kind of drag, right? How do you do that?
Hi, my name is Jason Raznick, the CEO of Benzinga, and welcome to the Raz Report. As always, before we kick things off, I want to quickly tell you about what Benzinga is. Before I started Benzinga in 2010, there were very few places to get real-time information on financial markets. I thought it was unfair that Wall Street had access to this information before the average Joe investor. So I created Benzinga to level the playing field for you, the retail investor. Benzinga is for the people and by the people. Now, let's dive into the show.
All right, everybody, welcome back to another episode of the Raz Report. Slightly different look today. Jason and I will be tag teaming this interview.
And this is Aaron Bree.
Aaron Bree, Jason Raznick. And today we are joined by Christopher Tsai, founder of Tsai Capital. Christopher, how are you doing today?
I'm great, Aaron. Nice to see you. Jason, nice to see you. And good morning.
Yeah, Aaron, don't you have more to say about Christopher?
Well, I mean, Christopher has an amazing story. Really needs no introduction. Has been investing for years. Christopher, you got started super early. I mean, founded your own thing when you were 22 years old. Invested in a lot of different things, from art to big tech companies.
You know, you say founded his own thing. Do you think people listening know what his thing is?
Well, Christopher, why don't you tell us what you founded when you were just 22 years old? I mean, to me, I can't wrap my head around. Jason met me when I was about 22, and he knew I was in no position to be founding my own.
I met him on Twitter.
To be founding my own investment firm. And you even got started before that, Christopher. I mean, just being that young, starting your own investment firm, walk us through that. How'd you get interested in investing so early?
I'll give you a little bit of the backstory. So I grew up in Greenwich, Connecticut. And there was a restaurant there called Lotus East. They made the best orange beef. So I loved going to this restaurant. And I also loved looking at companies. I got my first edition of Value Line when I was about 11 years old. I would go through the 1,700 companies in the Value Line book, and was fascinated by all of these different businesses that we could buy. Nobody could say no. Nobody could say, like a private company, you can't buy this. I love that democratic approach to investing in public companies. So I would go to this Chinese restaurant, and the owner there, Johnny Chang, also liked companies, but he would speculate. He would buy and sell. And I told him, that is not the way you're going to get rich. You got to think long term. And eventually, I convinced him to give me his entire life savings, which was about $400,000. And eventually,
wait, how old were you at this time?
I was about 16. So from around.
Did you have a good track record then?
I had no track record except for.
So why would he give you his life savings unless he's more
nearly $500,000 to a 16-year-old?
I can't even get Aaron Bree to give me $50,000.
I guess I was pretty persuasive. I mean, my track record at the time was not formal. I had managed some very small amounts of money that I had earned doing different chores like gardening, working as an intern for Waterhouse Securities, which had actually just gone public a little bit before then. Johnny was great. You know, Johnny trusted me, and fortunately, I did well for him. We did very well. I mean, over a several year period, I think I more than tripled his money. So it was a great time. But he was one of just a few local businessmen that I raised money from. I raised money from other people in town. I had roughly 5 clients at the time.
So at the time, you're 16 years old. He gives you $400,000 to start investing. What do you do? I mean, are you buying stocks? Are you looking at private companies? What was your first step of order there?
I was buying publicly traded companies. I had no idea how to even think about buying private companies. I mean, I had a very small amount of capital. Publicly traded companies is what I started looking at 11, and it's what Tsai Capital is all about today. As you mentioned, I founded the company when I was 22 years old. Jason, like you, I founded it out of my apartment. So it was a nice beginning. I have a lot of great memories working at my dining table, ordering takeout food. It was wonderful, and we've been growing ever since with the same investment approach, with the same and long-term investment approach focused on high quality growth companies from that very beginning.
So when you say we, is it like a firm like you and you have multiple people, or is we like what is the we?
I'm the only chief investment officer of the company, and I have great compliance that I've outsourced. I've got great people that I've outsourced many of the administrative functions to. I've got a wonderful advisory committee that's grown over the years, and a wonderful ecosystem of fellow investors that we constantly bounce ideas off of.
So, so the collective we, it's like you're running the operation. You've outsourced the administrative and the headache stuff, and you focus on the investing. So you basically have made a fund that you run, you manage, and you have outside capital. It's not just your own capital.
Correct. We have 110 million or so of assets under management today. There's so much that goes on with a regulated entity today. Tsai Capital is a SEC registered investment advisor. It's been registered since 2006. So there's a lot that goes on to running that kind of business. And there's probably about a dozen people or so that are working on Tsai Capital every single day, some sort of element from administration, compliance, and so forth. But it's all outsourced. And so it's extremely efficient and extremely scalable business model.
No, it makes a lot of sense. So the question I ask is, do you have marketers that help you go raise money, or is that what you do? Like, are you trying to get this fund to be $1 billion? And we're going to get into, guys, listeners, we're going to get into stocks. We're going to talk Tesla. You may hear some differing viewpoints there and other interesting companies, but I think the hedge fund setup is very interesting here, how he has it set up, Tsai Capital, how he's made it so efficient. And, he gets to focus on maybe just one or two things, which is picking the stocks and maybe the marketing of the fund. But that's what I want to get a little more into. So how do you grow a fund, or, how does that work?
I used to work with Mario Gabelli, and he was one of my first bosses. And at the time, also when I was a teenager, he said that asset management has high barriers to growth, but low barriers to entry. And that's still the same case today. So you need a unique story in order to raise capital. There's so much great competition out there in so many firms that have done well. But if you have a unique approach, a unique strategy, and you have a story to tell, I think that's very effective. And today, most of our clients are actually coming to us. Prospective clients are coming to us or being referred to us by existing clients. So there's a lot less selling, so to speak, on my part today than there was when I was 22, 23.
Well, the reason I bring that up, okay, I get approached by financial advisors, or I used to until they know I kind of put a wall up. But I get approached by financial advisors a lot, from Goldman, and I get annoyed that they're just always approaching and marketing and not doing what you're doing the research on the companies. And for you to be really good at your job, you're spending a lot of time doing the research on your companies, and you're not marketing all the time. So that's where I was like, okay, you have 110 million. It could probably be 300 million if you were out there like a financial advisor marketing all the time. Is that a hard dichotomy to decipher?
I think you hit the nail on the head. And my job is to make money for my clients and to help preserve their capital. And in order for me to do a good job at that, I need to be focusing on investing, looking at companies, managing that capital. So that's been my focus, and I'm very careful to make sure that I'm not distracted in other areas. What I do like to do is I like to write. We put out a publication called Investing in the Age of Disruption, which was highly well received. And writing that took a lot of time, but it also helped crystallize some of that thought process that goes into the types of businesses that we're investing in our approach.
Yep.
But you're right. I mean, there's a lot more room for growth, but for me, it's really about aligning with that right client, aligning with a client who truly understands our long-term investment approach, and that we're not trying to buy and sell. We're looking for growth over the long term. And if you don't have that right client, our strategy is not going to work well. We can add
Because you're
the
going to have
most value to clients if they're aligned with us. So a lot of clients that come to us, prospective clients, I wind up turning down simply because they don't fit within our ecosystem.
because you're going to have those years of down and ups. Is that what you mean by that?
You're always going to have years where you're not doing well, and you're going to have years that you're doing extremely well that might make you feel somehow invincible. In that particular period, when you're doing really well, you got to be very focused, because you're like a fly on the wall. You're going to get swatted. And I just have,
So-
yeah.
Go ahead. Sorry, I was just going to say. I mean, you mentioned that you have the same, basically strategy since you started when you were 16 and focusing on these long-term growth companies. I know you were influenced a lot by Charlie Munger's philosophies. What I guess going back then when you were younger, what drew you to those philosophies, and what did you like about them, and why you still kind of adhere to them today?
Early on, when I started investing and I had some money, I used to have almost nightly conversations with my late father, Gerald Tsai. And he was a much more short-term oriented person, not just in investing, but also in life. And while he did extremely well owning entire companies and holding those companies long-term, when it came to publicly traded companies, he often liked to buy and sell, buy and sell. And I realized from that moment, that was not my approach. It didn't mesh with my personality. And I wasn't good at it. So I learned, Aaron, pretty early on that I wanted to focus on the long term. I wanted to focus on growth companies. And Charlie was a huge influence to me, as he has been to so many other people. Charlie really made the point crystal clear that it's far better investing in high quality growth companies at attractive prices as opposed to mediocre businesses at really attractive prices at big discounts. You want to always focus on quality. And so quality has been a focus of Tsai Capital for a very long time now.
Got it. And then when you're looking at the fundamentals of a company, I mean, even, today, what are your, green flags makes you say, oh, wow, this thing looks really great. I want to keep looking into this. Or what would be your red flags to say, I don't really want to touch this?
Yeah, I mean, I love that question. And talking about my late father, we were out on my Boston Whaler when I was, 11, 12 years old. And I was fishing. I was just learning how to fish. And I cast my rod into the wind. And my father said to me, hey, you can't do that. It's like in investing. You have to position yourself with the wind at your back. So we're all about investing in businesses that are positioned on the right side of change. And Jason, you I think had an award. You won an award for disrupting financial media. And so I'm looking at businesses that are disrupting other industries, businesses that are really focused on the right side of change. So we don't own companies like coal businesses, oil and gas companies. We own businesses that are at the forefront of change, that are disrupting, that have innovative technologies, and have great abilities to reinvest capital over a long duration.
Got it. So is that maybe one of the genesis of Tesla? Like I'm a believer in Tesla. Aaron is not. And so, yeah. When did you come to Tesla?
I came to Tesla probably too late, but we've still done well with it. We purchased Tesla in February. We started purchasing Tesla in February of 2020 at an average price of roughly $41 a share. Today, it's obviously much higher. I started looking at the company several years before that. One of my mentors, Ron Barron, started buying Tesla way before I did. But I eventually started to understand the business, and I eventually started to understand that this was a hugely disruptive business, not just to auto, but to other areas, including software and energy. So Tesla is often a misunderstood company. It's an $800+ billion market cap that is so misunderstood by a lot of Wall Street, because investors are so focused on the company lowering prices, but that's actually an intentional strategy that Elon is replicating, and it's not new. Henry Ford had that strategy in the early days when he launched the Model T, constantly lowering prices to further the competitive economic moat and drive demand, which then results in a kind of a virtuous flywheel. Jeff Bezos has had that approach with Amazon, and Jim Senegal had that approach with Costco.
So do you yeah, Costco's all about volume, and so is Amazon,
For
I
sure,
guess.
for sure.
Yeah, and the membership fees. Do you drive a Tesla?
I don't have one yet because I'm living in Manhattan and I don't have a need for a car. But I am building a country house in upstate New York, and as soon as we make some progress, I'll have a Tesla.
Well, have you been in one?
I've been in many Teslas. You can't own a
Okay,
stock
that's what I mean.
unless you've actually used the
Yeah.
service. I'll tell you a quick story. I read somewhere, and I don't know if this is factually accurate, but I believe it to be true, that one analyst came up to, I think it was Stan Druckenmiller at some point, and said, he thinks that Stan should be short Tesla. Stan said, have you been in one? And the analyst said, no. Obviously, that didn't go so well for the analyst, but you got to try out the product, right, or service.
How do you decide to buy more shares in a stock? Amazon, I don't know, maybe a year and a half ago was at $96, or maybe it was less than that. Now it's approaching 150. How do you decide when to buy more? I bought Amazon more Amazon when it went down to 96, and then I didn't buy more, and I recently bought more. So, like, how do you look at that?
That's a great question. For us, it's always about what we think we can make on that investment from that point in time. So as an investment manager, we have capital coming in all the time. So we have to put new capital to work. So it's always a question of what can we make at that point in time, as opposed to where was the stock in the past? Because ultimately, stock prices are driven by that underlying intrinsic value, that business value, which is ultimately tied back to earnings and cash flow. So if the earnings and the cash flow are growing, and let's say they're growing faster than the stock price, then there might be some value there. And so we're always looking for a relationship between earnings and the stock price. If that makes sense to us at that given point in time, then we'll buy more.
So you recently sold some Apple shares, right? Last quarter?
We sold a little bit of Apple shares. It's still in our top 5 holdings. We did that in order to move some capital into some other areas where we thought that we're going to make potentially more money. Why we didn't sell the entire position is because there are no certainties in life except for death and taxes. And so we like to have 21 companies. We like to have a diversified portfolio of high quality businesses, but not so diversified that we cannot outperform over time.
It's kind of like Kathy Wood does that sometimes, where she'll have big positions in like big tech companies and sell some shares, but it's not because she doesn't like the company more. She would just rather hold those shares than have it in cash. Is that, kind of similar?
Yeah, I mean, I'm so happy you brought that up, Aaron, because we are not market timers, and holding lots of cash is in effect a form of market timing. We tend to run fully invested almost always, unless there's something, unless we cannot find quality companies to buy at reasonable prices, we won't hold cash. But we will change allocations across the 21 businesses that we own, depending on the environment, depending on what we're seeing, depending on price versus value.
So you mentioned the top 5 holdings right now. I mean, between Tesla, Amazon, Google, Apple, of course, a lot of big tech. A lot of talk has been about the Magnificent Seven the last year or so. I mean, going into 2024, do you think this sector will continue to have the wind at its back, that these companies continue to move higher in 2024, or could there be some sort of reckoning for big tech or a pullback in that market? What are you expecting?
Yeah, I mean, when we think about 1 year time horizons are actually in that short-term camp for us. But what I will say is that the wind is at their back. So we look at some of the large tech companies like Amazon, like Microsoft, like Alphabet, that own the public cloud, the three major players of the public cloud. We look at these companies as the infrastructure of the economy today, just like railroads were the infrastructure of the economy during the time of Cornelius Vanderbilt and Rockefeller. So we think that the wind is very much aligned at their backs, and world GDP doesn't really continue without that infrastructure today. They're vital to world economies. I'd also say there's so much data that sits on premise still on computer servers in offices. We are still at the infancy of the movement of that data to the cloud, and that should help drive the cloud businesses of these three players.
So what about any other picks though that aren't as well known, like other hosting companies and that kind of stuff?
Well, that's the great part, Jason. There are only three. There are only three major cloud players. So we own all three. It's such a hard business.
Microsoft, Google, Amazon, is that what you're saying?
That's it. They control the cloud infrastructure. It's too hard to break into because of the massive amounts of capital that come from forming these businesses, that are required to form these businesses. So today, these three players dominate the cloud.
What about some security companies like Tesla? I'm trying to find a picks that like maybe hadn't been as well talked about, or you're just like, it doesn't matter that they could be trillion. Like I own Lilly, okay, and I bought it because of the Munger, the whole weight loss stuff. I bought it even though it didn't work for me, and I got sick, so now maybe I should sell my Lilly. But anyway, that company is like at $600-700 billion. It's gonna be at $1 trillion. Like I'm like, okay, what's the derivative play? Like, do you ever look at what derivative plays are, or like smaller companies that you could have an abnormal return, or do you just stick with the leaders and that has served you well? I mean, you've been doing this since you're 16, and so.
I'll say two things. First of all, it's the nature of the world for the large to get larger.
Right.
And the world is structured in a way where inflation drives values higher over time. And I remember when my parents bought their home in Greenwich, Connecticut in I guess it was the late 60s, early 70s, right before I was born, they paid $1 million for that property, which was an enormous amount at the time. But today, it's many, many, many times that. And I also remember when I first started buying stocks, one of the companies had just crossed the 100 billion or so market value, and people said, how can it get any bigger? Well, today we're past $1 trillion, and there's no reason in my mind, because of compounding, because of inflation, that we don't have $10 trillion market values over time. That being said, we look across market cap spectrums. We're not just focused on large companies. We will look at smaller companies as well. We will look at mid-cap companies. So we go where it makes sense at the time.
Okay.
And
now I want to change
companies today across tech, across healthcare, across confectionery businesses. We have a whole.
Well, I don't know. Aaron didn't print out your 13F that's on Benzinga. Why didn't you print out his 13F? All his holdings.
I've already got it memorized. I know the top 5 off the top of my head.
You do?
Yeah, it's Tesla's the top one, like 36%.
But Jason wants to talk about some of the smaller companies.
I know. That's what we're on the hunt for some small,
Would you say I'm an idiot? Because listen, the end of 2021, I had a little bit of a liquidation event. We sold 55% of Benzinga, and I had
that was the Behringer, I believe, right?
Yes. Okay. You know your research, so you know your stuff, and I'll say I've been rather conservative. In the last year, I put more money in the equity market, but if I told you my portfolio allocation, you'll probably think I'm insane, okay? So I would say that I'm 80% bonds, municipals, 10% real estate, and like 5% the stock, 6% the stock market, or 7%. I thought I was a little more, and I really looked at this recently. if my time horizon, I don't need the money. If my time horizon's 20 years, is that the worst allocation you've ever heard?
I'm sure we can do worse.
Okay, but it's pretty bad. Like in the sense that the reason I bring this up to you is because you mentioned your parents' house, you mentioned inflation, and here was my logic. I have made a little bit of money, and I was like, okay, if I can get 5% on municipals or 7%, do that versus the market falling, and then I'm upset that I lost this because I'm not used to seeing that in the account, and I would see overnight loss, and it would just drive me nuts. So I'm like, you know what? I'll buy municipals, and then I see the market going up, so then I put more money in the market, and that's been good. But I guess what I'm asking you I'm asking you more of a time horizon. It applies to Aaron, it applies to me, it applies to anyone.
Everybody.
Aaron's in his 20s.
Yep.
What'd you say? Yes, exactly. And so the market historically goes up, but it's hard when you're in those years to see that. So what would you say someone in their 20 and 30s a portfolio allocation should be? Or what's yours? I mean, you're probably in your 20 or 30s.
Well, it's actually my birthday today, so it's a special.
Happy birthday! Let's do it. Play the music. We got to go. Ready?
Yeah.
Happy birthday to you. Happy birthday to you. Happy birthday, dear Christopher.
How do you go, Christopher or Chris?
I don't know.
Christopher.
Happy birthday to you.
That's the best birthday song
Thank
you're ever gonna
you.
get.
I know, and
Thank
but our hands weren't like.
I know. We got to work on our rhythm a little
Yeah,
bit.
our rhythm was definitely not what we. Yeah. Okay.
Thank-
So yes.
thank you.
So go ahead.
Um,
So your 30th birthday. Congratulations.
so 49 years in.
By the way, Christopher, I wish you could see the clock they put here for us to see the time. It is the most faded number in the history of clocks, and Aaron Thomas
Since we
can't
only
hear me.
got a minute left, and I have like four more.
I thought I said 3 minutes. I can't even
I have
read.
like 4 more questions I want to ask Chris.
All right,
No, but go ahead.
Let's tackle this one real quickly then, because I think it's an important one. Besides death and taxes, one thing is pretty close to being guaranteed, and that is the value of currencies decline over time. And we figure that every 15 years or so, the value of the US dollar gets cut in half, meaning your purchasing power gets cut in half. Not good if you have money in cash, not good if you have money earning a little bit of interest, because that money is just not worth very much. And if we talk about 15, 20 years out, your money will be less than half by that time. So how do you overset that kind of drag, right? How do you do that? You invest in quality companies that can sell products and services that can raise prices themselves to offset the effects of inflation. And that's why markets move higher over time, because prices move higher over time and earnings move higher over time. You want to be aligned. Again, we're talking about alignment of where the world is going. This is from a big macro standpoint. You want to be aligned with where the world is going, and that is inflation. Equities are a better way, in my opinion, to offset the effects of inflation than fixed income securities over time.
Got it. Well,
Generally-
Chris, our timer did go off. Do you have a hard stop, or do we have time for 3 more questions?
We can keep going. This is a birthday treat.
By the way, you should look at HubSpot. I mean, it's moved a lot. That's one of my biggest holdings. I buy it on weakness. I buy it whenever. And the reason I buy it is because competitors of ours and just in the space, they keep switching to HubSpot. I told Mark Benioff many years ago, when it was at $60, they should just buy HubSpot, but he didn't buy it. It's at $5.
Buying everything else.
We should do more work on it. Tsai Capital uses HubSpot.
Yes, you know what I'm talking about? It's my biggest. I think it's my biggest
I can tell
position
you
now.
that it would be a nightmare for us to switch away from HubSpot. So
I mean,
it's a very
so look at
business. We love
high switching costs.
high switching costs. Look, the moat. I mean, I have 6 digits in it, like a nice 6 digits, and I'm upset that I don't have a nice 7 digits in it.
So, Christopher, one of the things I wanted to ask about, going back to when we were talking about cloud computing. I mean,
I'm upset I don't have a nice 9 digits in it because it's up 60%.
Yeah.
You know,
we'll build the position.
I don't have the 9 digits, but I could get a loan from Christopher.
Jared, yeah. Oh,
Jared.
Yeah.
Who's Jared?
Golf.
Oh, your obsession. Yeah. Okay.
Going back to the cloud computing, you mentioned only 3 U.S. companies: Microsoft, Amazon, Google. That are in it now.
Worldwide too. They cover the world.
Oh, well, the question I was going to ask about Alibaba, because I know, they do a lot of cloud computing in China. That's been a stock I've been looking at, and kind of with the Munger philosophy. I know Munger himself bought some Baba and then ended up getting burned on it. But for myself, again, I'm in my 20s. Like I look at Alibaba, I look at its valuation. I think to myself, there's no way in hell that in 20 years this thing isn't worth 20 times whatever it's trading at now. Do you look at companies like that? Do you not like the risk right now in China, or why is Alibaba not something you'd be have in the portfolio?
Yeah, China is an interesting
Good
market.
question.
In the case of cloud, China is an exception because of how the laws are structured. Alibaba really has a quite dominant position. But these other three cloud players do cover pretty much the rest of the world. In terms of looking at Chinese companies in particular, we have been in the past invested in one or two Chinese companies. We typically prefer companies based here, though, that are multinational, just because we can get the exposure to revenue streams, earning streams from around the world, but we can do it in a way where there's comfort in terms of the accounting, there's transparency, there's rule of law here. So we prefer that, and we would rather sacrifice some potential return, for that safety that we believe we have over here. We have to remember, Jason and Aaron, that we're managing money not just for individuals. We have retirement money, we have corporate money, we also have charitable money. So it's very important to us that we're thinking not just about the growth of capital, but also the preservation of that capital. And so China kind of works against that, against some of those goals of ours.
Got it.
Did you go to your art one about the taxes?
Yeah. So the last couple of questions, I wanted to get to art. I know you're a big art investor.
Art and the tax thing.
Yeah,
I never heard of that. Where'd you find that?
Well, just you read things sometimes and they stick with you. I know, Christopher, some wealthy people, not yourself, but other wealthy people may use art investments as a way to, I'm not going to say avoid taxes, but maybe take advantage of some different tax codes and laws. How does that work?
I have no idea.
Good answer.
Really?
I know, but so
really, I have no idea. I will say, though, that from what I understand, depending if art is considered your investment versus art being a collectible item, there are differences in the way the tax code treats those two forms of investment. But I'm not familiar with the particulars of that. We don't buy art to buy and sell it. We're really buying art that we love, that we think has great value and will appreciate, but we have no liquidity issues. Our goal is just to create a collection that we can hold over a very, very long period of time.
Oh, so when you say we, you're buying art in the fund?
We, in this case, I'm saying we as family.
Okay, got it. So you just your art investments is just, or your art purchases are just personal, collected, not in the investment.
Correct.
Got it.
Correct.
Okay. All right.
This is, by the way, in the background is work by Ai Weiwei, who is a very close friend of mine and is in New York right now. You should interview him.
Wow.
He's an artist?
Ai Weiwei is one of the great artists.
One of the greatest, right?
We should commission him to do a new Benzinga mural.
Yeah, I'm sure he'll do that. No, but I have a good friend who just came back from Art Basel and and bought 2 pieces. I wonder if he has any of your guys. I got to meet this guy. I don't know. I got to meet him. Okay, by the way, on the art thing, on the taxes, that could be like if your stock account goes up and you borrow on margin versus selling stocks. Maybe that's that may be a way to borrow against your stocks. If your art portfolio goes up to, say, $20 million and you borrow against that versus having to sell it, I mean, maybe that's what they're referring to.
Yeah,
I don't know.
I mean,
I'll look into it.
I can say that you can borrow against art. Many collectors, investors have done that, especially when interest rates were much lower. It's gotten harder. The banks want diversified portfolios of art as opposed to single artist concentrations. They like large values, not small values. But if you have a large collection, you have a diversified collection, you can relatively easily borrow against that, use that money for other purposes. And what's interesting about art, unlike public equities, is it does not get reset in terms of pricing every single day. So there's much less likelihood of a margin call. It's like borrowing against real estate. There's not an underlying fluctuating value, which could then trigger a margin call. So many collectors, many investors like to utilize some sort of credit line that is not backed by a fluctuating asset class on a daily basis.
Okay. No, that's a good point. That's a good point. So you can, it's not, it's not every day
Right.
you have to worry about your loans. Okay, these are the quick, just fire questions. How many unread text messages do you have right now?
Zero.
About zero.
That I
Okay.
know of.
What do
Since we started this conversation.
You
Okay,
probably got
well,
about
you,
80 happy
you probably got about
birthday.
80 happy birthday. Okay, he's right. You're right. Okay, what do you like use tech wise? Do you use a Bloomberg, like what do you use? Benzinga Pro? What do you use to get your information?
Whole range of
Nothing?
services. Koyfin is one of my favorites. Koyfin.
I know it. I know it. That's funny. I'm friends with the founder. Okay. You do that for like the charting and comparing the stocks and stuff like that.
Fundamental analysis.
Got it. Did you ever use what was Y charts?
I have used it in the past, yes. I try not to actually look at stock prices very often. It's for us at least, one of the least important metrics to look at. What we're really looking at is what are those businesses that we own doing? How are they performing? Because ultimately over time, the stock prices and the businesses are highly correlated. But over a short period of time, there can be dispersion, which is equivalent to noise, and it can be very misleading.
Yep. Benzinga Pro is more traders heaven. We have the signals, 52-week alerts, highs, options, dark pools, but that's more of a trader's haven, not a long-term thing.
And really, really useful and almost necessary information for traders.
Yeah. Okay. And then the last question was, what is the best piece of advice that you've received?
That's a really great question. Off the top of my head.
Or from who, and
Yeah, it has to be advice that was not directly given to me by somebody alive, but advice that was given to me through his words. Those are the words of the late Fred Rogers. You all know Mr. Rogers' Neighborhood. He said there are 3 ways to ultimate success. The first is to be kind, the second is to be kind, and the third is to be kind. I think that was great advice.
I like it. I like it a lot. That is the...
Look, I'm wearing a red sweater today for like Mr. Rogers.
You look like Mr. Rogers. That is the bottom line. I think people get too defensive on the who and not the what. We could talk about Tesla, and Eric can give why he doesn't like it, and and you could give why you like it, and it doesn't have to become personal. And even building a company, we have 100+ people here. The biggest thing that I find is still people too focused on the who and not the what, and one of the ways to be kind is separate yourself, focus on a topic versus taking things, that are personal, that are not personal. So I love that. Be kind, be kind, be kind. And guess what? Rewind and be divine.
Yeah.
And that will sum up our interview with Christopher Tsai Ventures. If you want more info about it, what is the domain? You didn't even give me the URL for this.
Tsai, well, let me pull it up real quick.
Tsai Ventures?
No, Tsai Capital. Tsai Ventures is
it's www.tsaicapital.com.
TSAICAPITAL.com. Read his writings. We should publish some of your writings on Benzinga.
I was just gonna say that. You said you like to write. We can.
Yeah.
And if you're worried about anything, we can give you a little pen name or something. Give you a little
no. He's real name.
Piece out
real
there
name.
that went. It was very well received. So everybody knows I wrote it.
On your website?
On our website. It's called Investing in an Age of Disruption. It's on our website. It's in our library section on our website. I highly encourage your readers, your listeners to check it out.
I feel complete now. I've had Kathy Wood on, Christopher Tsai, Tim Draper. The list keeps going. And Aaron Bree, thank you for co-hosting. Christopher Tsai, thanks for going longer. Happy birthday. Happy 30th birthday. And what accomplishment, $100 million+ fund. And,
started when he was 16 years old.
I know.
Now I'm 49, so I've got some ways to go.
Well, Christopher, thanks again for hopping on the Raz Report. Hope we get to chat again soon in the future. Anytime you got some big news updates, enjoy the rest of your birthday, and thank you again.
Thanks, Aaron. Thanks, Jason, for having me.